Has the time come for the Fed to cease and desist all the ultra-easy money pump priming? Here now we've got two smart guys, Dave Goldman, former head of fixed income research at the Bank of America, and CNBC contributor Don Luskin of Trend Macro. Okay, we talk about this a lot. This Mr. Bernanke so far hasn't made any news. If he does, we'll be all over it. David Goldman, what are the risks that he is, in fact, creating a bubble?
Larry, there's a nearly perfect correlation during the past year on daily data between the broad commodity index and the trade-weighted dollar. Cheaper dollar, higher commodity prices, tick for tick, day by day, 80%. That feeds into higher gas prices, higher food prices, and so forth. Now, what else goes up when the dollar goes down? Bond yields, because we're borrowing nearly $1 trillion a year from foreigners. They need to be compensated for a weaker dollar. Higher mortgage rates, lower home prices. So we get a boost in the cost of consumption, a collapse in home prices. The average that the Fed looks at looks like low inflation. The Fed says, gee, we need more inflation because the average is low. It's completely ridiculous. You can't talk to them. It's like talking to Moonies. But we ought to have at least a modest tightening in monetary policy.
All right, hang on a second. Before we get to that, modest tightening. Don Luskin, on this show last week, famed financial journalist and analyst James Grant of the Grant's Interest Rate Observer, he predicted that the Bernanke policies were going to cause, quote unquote, a burst of inflation. That troubles me, Don.
Well, you know what, Larry? If you look at we just heard a lot of statistics in the last 30 seconds. Let me give you one, too. Headline inflation would have to leap 5.6% over the next year just to catch up to its 10-year trend. Core inflation would have to leap 1.8% just to catch up to its 10-year trend. In the United States, we have come through 2.5 years of basically a flat CPI, mostly actually deflation during that period. Bernanke is simply trying to catch up. He recognizes that a little bit of inflation, not a lot, is good for the economy.
Yeah,
Look what's
Larry,
happened in Japan for the last 15 years when there's been no inflation, a little bit of deflation. It's been terrible for Japan. So that's the Bernanke prescription. That's what he's trying to carry out.
The average is meaningless because you have deflation where you don't want it due to the weak dollar, which is the double dip in housing prices, and inflation where you don't want it. So the consumer is squeezed by higher prices.
Yeah, that all sounds good if you say it fast, except that housing prices aren't even included in CPI. So, you know, you're just wrong from the get-go, David. I'm sorry. Just doesn't work.
The rental equivalent, and there are housing inferences in the CPI, but Don,
yeah, but they're just inferences. The double dip in housing isn't included in CPI. That's just
not yet. But excuse me.
Well, maybe someday.
The low in the owner equivalent is one of the main things holding CPI down. The average is meaningless. The consumer is in a double bind from a poorer balance sheet because of his home equity and higher prices at supermarket and the pump, and that's why growth is terrible and will stay terrible.
Well, but what I don't understand is these high supermarket prices. And food price inflation over the last year is precisely the same as overall inflation. You act as though it's just sort of running away at the grocery store. It's just not factual.
Well, excuse me. We have a 50% increase.
What number are you using?
We have a 50% increase in the broad commodity index. That's going to feed into inflation down the line.
But see, when I go to the grocery store, I don't buy broad commodities.
Down.
I buy a box of Wheaties. I don't buy a bushel of wheat. Do you? I mean, I've heard of health food, but that's ridiculous.
That's right. It either squeezes the consumer or it's going to squeeze General Mills' profit. It has to be paid for by somebody. This is one of the things that Larry likes to call the silent killers of growth. One reason, though, Bernanke may not want to raise the funds rate is that would flatten the yield curve like a pancake. Banks are more dependent on the steep yield curve than ever before in the past for profits, and it would take bank profits down.
Don Luskin, let me just ask you, though, I don't know how this outcome is going to turn out. It just worries me that we're swinging from deflation to inflation, inflation to deflation, this stop and go, and it's really hurt the economy in the last 10 or 12 years. And I guess, you know, the Tom Honig argument from the Kansas City Fed, he's just retiring, that we're inflating the bubble once again. And Don, when we deflate the bubble, it'll be the third time in 10 years. I don't think this country can take that. That's the part that worries me. There seems to be no monetary or dollar stability, Don.
Couldn't agree more. We have got to get to a point where there's some stability so we can stop and re-examine what the whole mission of the Fed is and how they carry out that mission. But now is not the time to take a kind of root canal monetary policy where we just say, oh gosh, the Fed's balance sheet is bigger than it ever was before, so I guess that means we ought to tighten. You know, I'm sorry, that's just not looking at all the available evidence.
But the good news is because the dollar is so sensitive to the funds rate, and because commodity prices are being driven by the dollar, a very small rise in the fund rate, say 50 bips, would have an immediate effect, stabilizing the dollar, lowering commodity prices.
Yeah, it would cause a depression, too.
David, you would do it now?
50 bips would not cause a depression. I would do it right now.
All right, gentlemen, I got to leave it there. To be continued. Good discussion. I'm just worried about the risks, deflation, inflation.